Friends, welcome to Finance MCQ. So friends, in this series of lectures, we are covering important MCQs for your upcoming NHPC Senior Accountant Exam 2025. Today is lecture number 25 and we will be discussing some important MCQs from the topic Marginal Costing. Now let's begin the video. Friends, the first question is, which of the following is also known as variable cost? Option A, direct cost. Option B, indirect cost. Option C, fixed cost. And last option D, total cost. So friends, here the correct answer is option A, direct cost. So friends, direct costs which are directly attributable to a specific cost object behave in the same way as variable cost, changing in proportion to the level of production. Moving on.
Friends, before moving on to the next question, I would like to inform at Finance MCQ, we are offering NHPC Senior Accountant Exam course. The course covers the entire technical syllabus, that is 140 marks out of 200 marks. An entire course is having subject-wise, topic-wise MCQs, including past exams questions from other PSUs of similar nature. And this course also include NHPC previous year exam papers, which will be helpful for your exam preparation. So do avail this opportunity. Visit Finance MCQ website, take a demo of NHPC course and start your preparation. Further friend, you can use coupon code NHSA100 to get flat 100 rupees off on the course price. So now let's move to the next question.
Friends, next question. The term contribution refers to the excess of sales revenue over option A, fixed cost. Option B, variable cost. Option C, total cost. Option D, administrative cost. So friends, here the correct answer is option B, variable cost. So friends, contribution is the amount remaining after deducting variable cost from the sales revenue. So this amount contributes toward covering fixed cost and then generating profit. So the formula will be contribution is equal to sales minus variable cost. Moving on. Next question. The break-even point is the point at which option A, total revenue equals total cost. Option B, contribution equals fixed cost. Option C, profit is zero. And last option, all of the above. So please pause the video, think over each of the options given in the question and let me know the correct answer in the comment box. Friends, here the correct answer is option D, all of the above. So friends, all three statements are correct descriptions of the break-even point, a situation of no profit and no loss. Moving on. Friends, next question. The formula for profit volume ratio is option A, contribution divided by sales into 100. Option B, sales divided by contribution into 100. Option C, fixed cost divided by profit volume ratio. And last option, profit divided by sales into 100. So friends, what is formula for profit volume ratio? So the correct answer is option A, contribution divided by sales into 100. So friends, the profit volume ratio measures the rate at which contribution is earned per unit of sales. So it shows the profitability of a product. Moving on. Friends, next question. Margin of safety can be calculated as option A, actual sales minus break-even sales. Option B, profit divided by profit volume ratio. Option C, both A and B. And option D, none of the above. So which is the correct answer? Friends, here the correct answer is option C. So margin of safety represents the amount by which sales can fall before a company start incurring losses. So both the formulas are valid methods to calculate it. Moving on. Friends, next question. Which of the following is the limitation of marginal costing? Option A, difficulty in classifying cost into fixed and variable. Option B, it ignores the time value of money. Option C, it is not suitable for long-term decision making. And last option, all of the above. So what's the correct answer? Friends, the correct answer is option D. So friends, separating cost can be difficult. It's primarily for short-term decisions and like other traditional costing methods, it doesn't inherently account for the time value of money. Moving on. Friends, next question. The selling price is 10 per unit, variable cost is 6 per unit, fixed cost is given as 4,000 rupees. What will be the break-even point in units? So friends, what is the formula for break-even point in units? So friends, the formula for break-even points in units would be fixed cost upon contribution per unit. So here they have given fixed cost, that is 4,000 rupees. Contribution per unit will be selling price minus variable cost. So that is 10 minus 6 is equal to 4. So friends, break-even point in units will be 4,000 divided by 4, that is option A, 1,000 units. Moving on. Friends, next question. In marginal costing, the cost of the product is determined by option A, only prime cost. Option B, only variable cost. Option C, prime cost plus variable overheads. And last option D, that says total cost. So what is the correct answer? Friends, remember that in marginal costing, the cost of product is determined by variable cost only, and fixed cost is treated as a period cost. So, option B will be the correct answer. So, friends, marginal costing treat only variable cost, direct material, direct labor, and variable overheads as product cost, and fixed costs are treated as period cost. Moving on, friends, a high profit volume ratio indicates option A, low profitability. Option B, high profitability. Option C, the business is at break even. The business is, and last option is the business is making a loss. So, quite a straightforward question, friends. The answer has to be option B. This says high profitability. Friends, a higher profit volume ratio means a larger portion of each sale contributes to covering fixed cost and generating profit, indicating better profitability. Moving on, friends, next question. When making a make or buy decision, the most important factor to consider is option A, the relevant cost of making the product, option B, the fixed cost of the factory, option C, the total cost of making the product, and last option, the profit margin on other products. So, friends, think over it what should be the correct answer here. Here we are referring to make or buy decisions. So the relevant cost will be very important here. So the correct answer will be option A. So friends, the decision be based on a comparison between the cost of buying the component and avoidable relevant cost of manufacturing it in house. Moving on. Friends, next question. Which of the following is the key assumption of marginal costing? Option A, all cost can be classified into fixed and variable components. Option B, fixed cost per unit remains constant. Option C, variable cost per unit fluctuate with the volume of output. Option D, selling price per unit changes with the volume of sales. So, what's the correct answer? Friends, the correct answer is option A. All costs can be classified into fixed and variable components. So, friends, this segregation is the fundamental principle upon which marginal costing and cost volume profit analysis are built. Moving on. Friends, next question. The angle of incidence in a break-even chart indicates option A, the rate of profit, option B, the break-even point, option C, the margin of safety, and last option, the total fixed cost. So, what's the correct answer? Friends, here the correct answer is option A. That says the rate of profit. So, friends, we have also given the explanation. The angle of incidence is the angle formed at the break-even point where the total sale line cuts the total cost line. So, a large angle signifies a higher rate of profit earned after the break-even point. Moving on. Friends, next question. If fixed costs are rupees 10,000, profit volume ratio is 40% and the desired profit is given as rupees 5,000, what is the required sales? A, 37,500, option B, 25,000, option C, 12,500, and last option, 50,000. So, friends, here they have asked us to calculate the sales. So, what would be the formula? The formula will be fixed cost plus desired profit upon profit volume ratio. So, 10,000 plus 5,000 divided by zero point 0.4. So, you'll have to just solve the equation and you will get option A, rupees 37,500. Moving on. Friends, next question. Closing stock is valued at dash in marginal costing. Option A, variable cost. Option B, total cost. Option C, fixed cost. Option D, market price. So, what is the correct answer? Friends, it is option A. So, only variable costs are considered product cost in marginal costing. So, inventory both opening and closing is valued at its variable manufacturing cost. Moving on. Friends, next question. Marginal costing is most useful for option A, short term decision making, and second option is long term planning. Option C, external financial reporting. Option D, performance evaluation of a division. So, friends, remember that marginal costing will be useful for option A, short term decision making. And why is that? Because marginal costing is invaluable for decisions like make or buy, accepting special orders, or optimizing product mix, which are typically short term in nature. Moving on. Next question. Company produces a single product with a selling price of rupees 20 and variable cost of rupees 12 per unit. Fixed cost is rupees 40,000. If the company sells 6,000 units, what is the profit? Options given are 8,000, 12,000, 20,000, and last is 48,000. So friends, here the first step would be to calculate the contribution. So how will we get contribution? We will have to deduct selling price and variable cost. That will be 20 minus 12, that is 8, and number of units is 6,000 rupees. So friends, our contribution will be 48,000 rupees. Next step, friends, we'll have to calculate profit, and that we will get by deducting fixed cost from contribution. So rupees 48,000 minus 40,000 will be, the correct answer will be option A, 8,000 rupees. Moving on, friends, next question. The difference between absorption costing and marginal costing profit is due to the valuation of option A opening and closing stock, option B fixed cost, option C variable cost, option D sales revenue. So friends, what is the correct answer here? Friends, the correct answer is option A closing stock and opening stock. So friends, the difference in profit arises because absorption costing includes fixed manufacturing overheads in inventory valuation while marginal costing does not. So this difference is carried in the valuation of opening and closing stock. Moving on. Friends, next question. The concept of key factor or limiting factor is relevant in which of the following decisions? Option A product mix decisions, option B make or buy decisions, option C accepting a special order, and last option pricing decisions. So friends, what is the correct answer here? Friends, remember that key factor or limiting factor is relevant for option A product mix decisions. So friends, when a resource like labor hours or machine hours or even raw materials is scarce, the company must decide which products to produce to maximize contribution per unit of that limiting factor. Moving on, friends, next question. If a company has profit volume ratio of 25%, what does this mean? Option A, for every rupees 1 of sales, the contribution is rupees 0.25. Option B, for every rupees 1 of sales, the profit is 0.25. Option C, variable costs are 75% of sales. Option D, both A and C. So friends, what is the formula for profit volume ratio? So it is contribution divided by volume. So here the profit is in its truest sense not a profit but a contribution. So that means option A is 100% correct. That is contribution is 0.25. And what is the formula for contribution? Contribution we will get by deducting sales minus variable cost. So option C will also be correct. So friends, the correct option here will be option D, both A and C. So friends, a profit volume ratio of 25% means contribution is 25% of sales, since sales is equal to variable cost plus contribution. So it follows the variable cost must be the remaining 75% of sales. That's what I explained. Moving on. Next question. Shutdown point is the level of activity at which option A the contribution is just significant to cover the avoidable fixed cost. Option B the company makes zero profit. Option C the sales revenue is zero. And last option the company covers all its fixed cost. So what is the correct answer? Please think over it, friends. The correct answer is option A. The contribution is just sufficient to cover the avoidable fixed cost. So, friends, the decision to temporarily shut down depends on whether the contribution earned from continuing operation is enough to cover the fixed cost that could be avoided by shutting down. So, that's all for today, friends. See you all in tomorrow's lecture where we will be covering some more important MCQs from the same topic of marginal costing. Till then, thank you very much for watching. Take care and goodbye.